This is our Forex blog for May 30th, 2013, and these are our currency indexes. And what we've done is we actually compare all the dollar pairs to each other and create a chart that shows what the dollar is doing, what the euro is doing, what the Australian and New Zealand are doing. And for the last 7 or 8 years, we basically focused on having currency meters that showed you statistically what the strength or weakness is, but it doesn't actually let you see double tops, bottoms, trend line breaks, flag patterns, such as right here. Flag patterns are very highly predictive of trend continuation. Anytime you have a big move with a flag pattern, a breakout of that is very highly likely. And with the old currency meter, you can't see flag patterns and slightly higher highs that fail to go higher. You can't see what the previous day's low is of the dollar index. So whether you use our statistical currency meter on the bottom of the index, currency indexes or not, it's up to you. Here's what they look like with all of them. Basically, as you can probably guess, you want to focus on buying the strong ones versus the weak. It's always best if you focus on currencies that have the daily and the weekly trend that's up, such as this one, and it's also best to focus on currencies above the hourly to buy. As you can see, the euro went above the hourly and continued its trend. Same thing with the dollar. Once it came back underneath its hourly, it trended down for an hour. So basically, you want to focus on buying the strongest versus the weak. You can see the New Zealand's underneath its hourly. The daily trend super weak. The weekly trend shifted down here. It broke down underneath its previous day's low at 430. So at 430, the Swiss was above its previous day's high. At 430, the pound was going up. 430, the yen was trending up. And so basically you can sell the New Zealand versus any of those pairs. And even when the yen started falling later, if it's falling slower than the New Zealand, if the New Zealand's crashing and the New Zealand or the yen is just slowly going down, you're still going to get a nice sell in the New Zealand yen. So here's 430 in this pair. You can see it's trending down. You have a nice little pullback right here, and it trended down. The pound, started getting really strong, so the pound New Zealand is very likely at 430 to be going up. And you can see on this chart it's above the hourly here. Here's 4 o'clock. It's in a little kind of decreasing volatility pattern, wedge pattern, breaks out. And this is a nice, 40 plus pip move. You buy the next pullback with your stop underneath here. And anytime you take these trades, you're risking basically what? A pip or two underneath the next swing. This is the tiny amount you risk. And when you focus on the ones that are most likely to continue going up, you're never going to catch every pip. Even if you got out of this last one right here, you made 3 to 4 times more than your risk. Here you made 2.5 times what your risk is. And that's really the key. You don't have to even worry so much about being right as you do focusing on ones that are likely to go your way. Now in this case, the daily and weekly trend is down. It starts the day off underneath the hourly right here. What currency is strong from 12 to about 5? The yen is. So selling the CAD yen early on in the day till about 4:30, 5 makes sense. Weak CAD, strong yen. And if you did that, guess what? Here it's hovering around its hourly, and it never really, it kind of had a false breakout right here, but a little out after 1 it broke down. This is about a 20 pip move. You got a little pullback trade right here. That also continued down. If you sold right here, you might have got stopped out. You had to get back in it. You can see that next trade worked. But the point is, when you take these trades and you have tiny amounts of risk, the one trade on this example that lost, you would have made a part of this move, a part of this move, lost here, and a part of this move, And you can just simply draw the trend lines over the highs, or use chandelier stops, or you can draw fibs on previous moves to get an idea of where your profit is. Most of the time the fib targets are great places. You can also use our perfect oscillator to let you know when to get out. When it's at a minus 80 level, it tends to reverse back up, as you can see there and there. So, a lot of these tools are very helpful in not only timing entries, but also getting out. And one of my favorite methods is when I see a market make a lower low, or at least a lower low for the last 5 or 6 hours, Doesn't have to go underneath this low, but the last few hours. When it makes its way back up to the upper Bollinger Band of a perfect oscillator, this is usually a pretty safe place to look for a short. It's also a 50% retracement. You get short. If you really are timing this, you can really get into a lot of trades at the 50 and 62% level. You know, kind of it went above it, came back down, you're short, you have a super tiny stop. You don't even have to wait for it to break the previous bar's low. And in this case, you know, you're risking a ridiculously tiny amount with a preconceived profit target, which happened to hit, already formed. And that's, you know, what, 10 to 12 times bigger profit than what your risk is? I mean, it becomes ridiculous. When the more tools you use, fibs, trend lines, you know, obviously we have trend channels too. Those work better in orderly trends, but you can draw trend lines over the highs and then plot them onto the lows here. And, you know, also use those. And when you have a trend that's down, you sell the upper quadrant, you get out at the lower quadrant. You sell the upper quadrant, and you can see this one kind of had trouble. It broke out above here. You would have probably had a loss. You get short again. It came back down. It can't break the middle line. Pretty big sign that the move's over. And when it finally busted through this trend line, it created a big trend. But there's so many tools we have in the software that you can use that makes trading quite easy. You can also anticipate price direction. For instance, double tops, double bottoms, very high probability. The yen came up to the previous day's high, highest high it made all day yesterday, couldn't get above it, pulled back. A lot of times the second or third time it busts through. Comes up here in double tops, can't bust it. So you might, you know, draw a trend line on this. When it breaks the trend line, you have confirmation the trend's likely to go down. That's at 520. And so what would you want to be buying? What currency would you want to buy against this very likely to go down yen? Well, the pound's going up. The euro is at yesterday's most actively traded price here. If it breaks through that, it's likely to go up to the previous day's high. It's a good distance away. So I'd take a 520 euro yen buy and pound yen buy. And this is how I use this to kind of predict with a very high degree of accuracy what's going to happen in the future. So here's 520 on this chart. And guess what? It came back up to the hourly. So I would kind of wait for it to go above this high and above the hourly. You're in. And it kind of goes sideways right here. If you want to exit at 25 to 30% of your trade, tighten your stop, and then it explodes up. And guess what? It went right to our 2.0 containment band, which most of the time, probably 70% of the time, is the maximum move. If you zoom back out, you'll see how frequently that level gets hit and reverses. Sometimes it's only the one level. You can see it down here, the 1.5 red band. So our tools make trading really ridiculously easy, I think, when you learn how to use them. And you can predict, like I said, what's likely to happen. So the euro was one of them. The pound looks like it could bust through its previous day's high, and if it does, everyone who is pretty much short the pound is all scrambling for the exits. This one also went above last week's most actively traded price. So below that level, shorts from last week on average were losing money or making money. Above that level, shorts are losing money. So you're going to likely get a short squeeze causing the pound to go up. And we know the yen's likely to go down. This will be the last example today. Pound yen around 520. This one was a little stronger than the euro coming up to 520. It already went above its hourly. So if you bought this breakout right here, with your stop underneath here, kind of went your way a little bit, pulled back. A lot of times I'll tend to, as it goes back up and fails, I'll get out of the trade with a small win right here. And because I'm expecting it maybe to reverse. In this case it doesn't, so I'm going to bust through here, I'm in again, and out at the upper band. But again, small risk, big profit. If you held on and because it never came down and stopped you out, you can see whether you got out at the high here or somewhere down near the low, you made many multiples of what your risk is. And that's how you use our software to anticipate future price moves with super tiny losses, 6 to 12 pips max, and wins of 1.5 to sometimes 5 to 10 times bigger than what your risk is. So again, even if you are right 1.5, if you make 1.5 times bigger wins than losses, you know, you can be pretty much 40-45% profitable to break even or make a little bit. If you're making money 50% of the time, you're going to have a good trading record.